Good afternoon. My name is Rubiat Jalil. I am here today with Romario, Tiffany, Sadna, Jason, Alexis, and Kirabel. Today we're representing Bureaucrat Investment Group, and today we'll go in our part. We'll go step by step through our portfolio on what our stocks that we invested in, what's the changes, and what our analysis is. Now I'll pass it off to Kirabel. He was the first stock.
Okay, so the company I chose to invest in was PepsiCo. It is a multinational American food, snack, and beverage corporation founded in 1898. So the company encompasses all aspects of the food and beverage market. It oversees manufacturing, distribution, and marketing of its products. It was formed in the 60s as a merger of Pepsi Cola and Frito-Lay. And since then, it's expanded and diversified range of food and beverage brands. It has numerous subsidiaries such as Gatorade, Quaker Oats, Tropicana, and Naked Juice, and it's a large company. So when I first purchased my PepsiCo shares, I purchased 859 shares for $166.30. Since then, the total exchange has been an increase of 4.46% and a total gain of $6,000, over $6,000. The last price after I purchased, the last price of the stock was at yesterday. It was $173 per share. Now the competitors for Coca-Cola and Kellogg's, the PepsiCo stock has a much higher value, over $100, while the price of the Coca-Cola company is 62 and the price of the Kellogg's stock is 64. The EPS for PepsiCo for PepsiCo 730.31, which is much higher compared to its two main competitors, Kellogg's and Coca-Cola. For Coca-Cola, the EPS is 2.37, and for Kellogg's is 4.33. So that would make me prefer the PepsiCo stock because the higher the EPS, the higher the value. The PE ratio for PepsiCo is 23.76. The PE ratio for Coca-Cola is 27.73, and the PE ratio for Kellogg's is 6.86. Out of these three investments, I would prefer the Kellogg's investment, the Kellogg's investment, because it had the most attractive PE ratio. The lower, the better. The PEG ratio was for PepsiCo was 3.27, for Coca-Cola was 3.82, and for Kellogg's it was 4.71. Now the return on investments for PepsiCo was 19.22% as of March 31st, 2022. Around the same time for Coca-Cola, it was also 16.22%, and for Kellogg's it was 14.46. Out of these three stocks, the most favorable return on investment is PepsiCo, because it indicates the most favorable investment, and that goes for the same with the ROE. The ROE is 63.2% for PepsiCo, and it's 41.19%, and it's 37 for Coca-Cola, and 37.61% for Kellogg's. And once again, the ROI for PepsiCo is the most valuable, the most favorable investment. Now the debt to equity ratio is 2.2% for PepsiCo, and so 1.678% for Coca-Cola, and 1.922% for, sorry, not percent. I've been saying it wrong. Not percent. 1.922 for Kellogg's. The most favorable debt to equity ratio is Coca-Cola, because it has the lowest debt to equity ratio, and that indicates it has the least debt on the balance sheet. Now the payout ratio for PepsiCo is 58.82%, and for Coca-Cola the payout ratio is 71.73%, and for Kellogg's is 51.67%. So the most favorable payout ratio goes to Kellogg's, because the payout ratio is between 35% and 55%, which shows stability. It doesn't go over or under, while the other two stocks go over. That's all the ratios I'm going to go over. My conclusion is that I would hold the PepsiCo stock over its competitors because it has the most value, the highest earning per share, and the highest ROI. Now I will pass it on to Rubiat. I mean, not Rubiat, sorry, Romario.
So the stock that I chose was Petrobras, and I'm gonna refer to it as PBR from now on. I know you guys see a lot of numbers there, but we're gonna see them again. Just move to the next slide. I chose my competitor to be ExxonMobil because I wanted a challenge to see how good my financial knowledge was. It wasn't that good. Spoiler alert. Another slide. Okay, so here I'm gonna actually compare Petrobras and ExxonMobil and what I consider to be the important ratios. So first off is the inventory turnover. So Exxon has a higher inventory turnover than PBR. That means it sells more inventory quickly, but the inventory industry average is 10.54, and Exxon is still doing better than the industry average. For the ROI, PBR is doing better with 19%, meaning that they're making more on their investment. The industry average is 11.02, so they're still doing better than the industry average. And Exxon is doing, I think, 9%. Sorry, 7. Total asset turnover ratio. So both total assets turnover ratio is less than 1, meaning their assets aren't able to produce enough revenue. But the industry average is 0.85, and Exxon is closer to that than PBR, which is 0.28 versus 0.4. The next ratio is time interest earned. More favorable time interest earned is a higher one. It's like your credit score. It shows like how credible you are in paying back your debts. And Exxon beat PBR by like a lot. They had 25 and PBR had almost 6, but it said that it's acceptable for to lend to companies that have more than a 2.5, even though the industry average is 16.14. Now to the PE ratio. A high PE ratio is bad for investors. So PBR is more favorable here because they have a 5.92 ratio versus 17.04, and the industry average is 14.8. Let's add growth into the P and make it into a peg. A lower peg is better because it's less peg for you. Exxon has 1.13 peg, while PBR has 8.73, and the industry average is 1, sadly. And now to the payout and retention ratio. Respectively, payout ratio is what you give back to shareholders, and a retention ratio is what you keep for yourself. The PO ratio for PBR is 67%, and for ExxonMobil is 58%. And the retention is 32.85% and 41.96% respectively. So the market cap, margins. Net profit margin, PBR makes 24 cents on the dollar while Exxon makes 8 cents. This might indicate that PBR is more financially efficient, but the industry average again is 9 cents, so Exxon isn't that far behind with 8 cents. Their earning before tax, PBR they increased their gap to 6 cents per dollar, while Exxon went to 20 cents and the industry average is 11 cents. So both of them are above the industry average. And I should mention that the EBT ratio is much better comparison than net profit margin because there's a lot more variables included into it. The gross profit margin, PBR did better again. Their gross profit margin was 48% versus 23.45 on ExxonMobil. And the industry average was 51%. So both of them did worse than the industry average. And lastly, the profit margin. PBR and ExxonMobil made 39% and 8.68% on the dollar respectively, which is how much they make on the dollar before paying interest and or taxes. The industry average is 18%. So in this case, PBR did better than ExxonMobil and the industry average. So the market cap. Exxon has a market cap of more than 4 times that of PBR. It might be a result of Exxon's brand name, supply to more customers, acquire from like research and development, or like brilliant future investments. It might also explain why their retention ratio is much higher. They keep more money to invest into themselves, so they could have like a better market cap and more investors. Next slide, please. CAPM and WAC. I'm do both of those together. So higher CAPM means a higher return, but also means higher risk. CAPM has a relationship with expected returns and risk of investing in securities. CAPM is used to determine the value of WAC. A high WAC means high risk associated with the company's operation because the company has to pay more to compensate their investors for the capital. Exxon WAC is almost 6 points more than PBR, which means that Exxon pays more for the capital that investors put into their company. Next to the Gordon model. PBR is a great example as to why the Gordon model isn't recommended for all stocks that pays dividends, since PBR dividends aren't consistent. Unlike Exxon's, PBR can lead the Gordon model to overestimate expected returns, which is shown there by like a 14.95 rate of perpetual return, which is absurd, and Exxon shows much more of a stable perpetual return. Now to free cash flow. Free cash flow, PBR has 18.2 billion in free cash flow, while Exxon has 9.6. Free cash flow is basically what's left over in cash for companies to pay bonds, interest, dividends, and what's not. After like a fun fact, after using like the market cap and the price per share, it shows that PBR pays almost 8 billion in dividends, while Exxon pays 3.8 billion in dividends. This is because PBR has more shares than Exxon because of their lower price. And intrinsic value. So intrinsic value is like a determination of if a stock is overpriced or underpriced. And after my calculations, it shows that PBR was like undervalued because I bought it at 14.24 and the intrinsic value I got was 18.01. It might seem that ExxonMobil is also undervalued because the intrinsic value is almost $84 and At the time, I think it was February 16th, the price of ExxonMobil was $78, but the industry average for energy companies are $24.61. So that might be a reason why uh it might be overvalued on Yahoo Finance. Next slide, please. This is just like the growth rate to show the 3 months of PBR from when I bought it to the 13th, which is Friday. It shows the beta and the, well, I should say the volatility of the stock due to maybe the unpredictable market in like the oil industry due to the war with Russia and Ukraine. Next slide, please. Thank you. And this shows the same thing, but for ExxonMobil. A little fun fact is that ExxonMobil, even though their price is higher and I would get less share for the same amount of money, the total return if I would have sold on Friday, I would have gotten more money. Next slide, please. So in conclusion, as a way to show my lack of financial knowledge, I chose to compare my cheap stock with larger dividends. I assume dividends would have carried more movement than a blue chip stock. So I compared it to none other than the 10th place company on the Fortune 500 list, ExxonMobil. And also it was a mangoes to mangoes comparison. So it was in the proper constraints for this comparison. After doing some calculation based on the price as of the 13th of May 2022 and the 16th of February 2022 on both PBR and ExxonMobil, it shows that PBR would have had a higher return on dividends, but ExxonMobil would have a higher overall return. And the increase in the stock price combined with the dividend payout for Exxon would have been a gain of more than $5,000 over PBR. And again, this might be due to like a lower beta or the war in Ukraine due to Exxon having like a much more like recognizable name. And lastly, my advice would be to invest into Exxon instead of PBR because you can accumulate more gains on Exxon than PBR with the same amount of money if you hold it. And now I'm gonna pass it on to Tiffany.
Okay, so my stock is AbbVie. It was created in 2013 as a spinoff for Abbott Laboratory. They do biopharmaceuticals, and most of their revenue comes from the drug Humira, which is the top selling pharmaceutical. Originally, I invested in AbbVie because it was on the cannabis watch list, and I feel like cannabis is becoming less stigmatized in the United States and bringing in more revenue. And it was also on the Berkshire Hathaway watch list. My graph just shows the price of the stock increasing since its inception, and we can go on to the next slide. For my analysis, I focused purely on the stock valuations that we learned in the last quarter of our class, so this will be pretty quick. The first analysis I did was for AbbVie versus Abbott Laboratory, even though these two aren't direct competitors because AbbVie does biopharmaceuticals and Abbott does medical devices. The point of a spinoff is because you believe that these two entities will operate better separately, or there's blood in the water and you believe that it will tank. So I went to see if Abbott was correct in its assumption. Most of the differences between the ratios that I did are pretty negligible, but there are some where Abbott does a bit better, particularly for the PEG ratio. I excluded PE because PEG is a bit of a better indicator, so I felt there was no point of having the PE ratio. But for the PEG ratio, Abbott is 299 versus AbbVie being 4.12. A PEG ratio over 1 means your stock is overvalued in comparison to the price earnings. So both of these stocks are overvalued, but Abbott is a bit less overvalued. For the WACC, Abbott is also a bit lower, but they are pretty similar. It just means that one has a bit less for the cost of capital. As for my Gordon's model and intrinsic value, both of them are talking about stock price. And the only reason I did another for intrinsic value is because for most of my ratios, I source the information from financial statements, such as the income statement, balance sheets, and the 10Ks. And this is only Finance 3000. So I want to back it up with people who have had more than an introductory finance class. For my Gordon's model, it shows that AbbVie is a bit less overvalued than Abbott, but for the intrinsic value that I got from another source, it shows that Abbott is actually closer to the market value. And Abbott also has a bit higher of a rate of return. All this points to ABV being a bit more overvalued and probably a worse investment. And then this chart to my right shows the increase or decrease in stock price in the last year. As we can see, Abbott Laboratories is having a bit of trouble while ABV has been growing. So while these valuations show that Abbott may be a better stock to invest in, there are other indicators that we need to look at in the future because the math isn't adding up because ABV is doing better on the market. And we can go to the next slide. AbbVie and Pfizer are both biopharmaceuticals. And as of 2021, Pfizer actually has the largest injectable drug treatment being the COVID vaccine, whereas it used to be Humira. In this, Pfizer is definitely beating AbbVie in almost all categories. The beta is slightly lower. The PEG ratio is below 1 and significantly lower. And this means that Pfizer is undervalued and not overvalued. The WACCs are a 0.02 difference, so their cost of capital is pretty similar. The CAPM for AbbVie is a bit higher. CAPM does use risk as a way to evaluate it. So you can be into a small CAPM or a larger CAPM. I don't think it's an end-all be-all. And as for the Gordon's model and intrinsic value that I have, it both shows that Pfizer is undervalued while ABV is overvalued. And ABV only has a slightly higher rate of return. So overall, I think Pfizer is a better investment. And then the graph to the right shows that both of these stocks are increasing at a pretty relatively like the same rate. So I think they're both pretty similar investments. And then we can go to my last slide. What would I do? I do think ABV is still a good stock to hold. It pays great dividends and they are increasing every year. However, ABV is actually losing their patent to Humira, which is where they get all their revenue from. They have been diversifying, but I believe the loss of this patent, which will allow generic drugs to be used, will cause investors to be shocked and decrease the price even temporarily. So I believe we can exercise put options. As for Pfizer, while the dividends aren't great, a lot of the ratios are pretty similar to ABV, which I still think is a good company. And it is currently undervalued. So I believe it is something that either A, I would buy or exercise call options. And then I'll pass it on to our next presenter, Sadna.
This is the last presenter of part 1, and we'll see you in part 2. Okay, guys. Sorry, this is part 2. Now I'll pass it off to Sabna.
Okay, so I decided to invest in Procter & Gamble. So a little bit of background. Procter & Gamble was founded in 1837 by William Procter and James Gamble. William Procter was a candle maker and Gamble was a soap maker. They met by chance and they went on to start a company that would go on to be a leader in the consumer goods industry. So why I chose P&G? I chose to invest in Procter & Gamble because it's a part of the consumer goods industry and it's also a consumer staple stock, which means it tends to hold up during economic downturns, unlike consumer discretionary stocks. And the consumer discretionary stocks contain stocks or products and services that people want instead of need. And on the right-hand side of the screen, I listed some of the brands that fall under Procter & Gamble, and the most notable ones to me, in my opinion, are Tide and Gillette. Next slide, please.
Sorry, hold up. There you go.
Okay. So my original investment, as of May 13th, the current price for Procter & Gamble was $153.62, has a market cap of 368.6 billion, earnings per share of $5.69. It has a relatively high PE ratio, which shows that it may be overvalued. It has an annual dividend of $2.65. And the price that I paid for it in February was $159.82. I bought 894.76 shares. So my total investment was $143.27. And my return on investment was negative 3.15%. And this graph I have on the right side of the screen shows how P&G has been doing since the beginning of the year. And it looks like it jumps around a lot, but it actually hasn't gone past the $140 to $165 range. Okay, next slide, please. So I decided to compare P&G to Unilever, which is a company that's very similar to P&G because it's a conglomerate with multiple household name brands. So first off, when it comes to stock price, Unilever or P&G has a stock price that is almost 3 times higher than Unilever. P&G also has a beta that's higher, which means it's more sensitive to market volatility. A good thing though is that, well, not a good thing, but P&G has a higher PEG ratio, which is not good compared to Unilever's PEG ratio of 2.76. P&G also has a return on equity of 31.17%, while Unilever has a higher return on equity at 33.22%. P&G has a higher CAPM of 6.01, while Unilever has a CAPM of 3.70. Earnings per share, P&G has a significantly higher earnings per share. It's almost double that of Unilever, which means they make more per share. P&G also has a higher dividend, and the Gordon's model shows that P&G has an intrinsic value higher than what it's actually priced at right now. And even though sometimes it's not totally accurate. And for Unilever, the Gordon's model shows that it's about the same range as where it is right now with its current price. P&G also has a higher payout ratio of 64 cents compared to Unilever's 22 cents. Next slide, please. So what would I do? I would definitely hold the stock. I kind of regretted buying it after I saw how it did over the last few months. However, I definitely think that this is a stock that has long-term potential once the market stabilizes and we see less of the volatility that we've been seeing over the past 2 years. And now I'm going to pass it off to Jason.
Thank you, Sadna.
Next slide.
Yeah, next slide, please. Okay, so my company is NVIDIA. So NVIDIA is a corporation. It is an American multinational technological company incorporated in Delaware and based in Santa Clara, California. It is a software and fabless company which designs graphic processing units, other known as GPUs, application programming interfaces, APIs, for data science and high performance computing, as well as system on chip units, SoCSs, for the mobile computing and automotive market. NVIDIA is a global leader in the artificial intelligence hardware and software from edge to cloud computing, and expanded its presence in the gaming industry with its handheld game consoles, Shield Portable, Shield Tablet, and Shield Android TV, and its cloud gaming service, GeForce Now. Its professional line of GPUs are used in workstations for applications in such fields as architecture, engineering and construction, media and entertainment, automotive, scientific research, and manufacturing design. Next slide, please. So my analysis. Currently, all stocks have taken a huge hit in the market as stock prices have dropped a significant percentage. Currently, unfortunately, I've picked the worst stock on ROI within our portfolio, but I still have hope for my stock. Currently, our group is down roughly $50,000 on NVIDIA alone, and we currently own 553 shares at an average cost of $258.46 a share. The current value of NVIDIA's portion in our portfolio is roughly $96,000. If there's one thing I could do differently about purchasing these shares, I would have bought them over time rather than all at once. I found out that this method is called dollar cost averaging, and it allows investors to average their cost basis over time and to minimize risk of losing their investment. So the ratios, the EPS is 385. It is a bit low, but I do see improvement over time. Right now, with the current supply chain issues, shortages, NVIDIA and other companies have been experiencing many problems, and I think that's why at the moment its current ratios are not the best for new investors. Their PE ratio is 45.7. This ratio is a little bit higher than what is preferable. Like I said, I think the current economical state is what is making these ratios look unfavorable to investors. The PEG ratio is 11.87. This number is also unfavorable to investors and can indicate whether the stock is overvalued or not. And currently it indicates that NVIDIA is overvalued, but I beg to differ. I actually think NVIDIA is undervalued, and here's why. Next slide, please. So the Gordon Growth Model. The Gordon Growth Model indicates the intrinsic value of each stock. NVIDIA currently has an intrinsic value of $239.71. This shows that the stock is currently undervalued and can be a good investment at the current price. I would definitely recommend this. Because NVIDIA is a semiconductor giant and it will be around for a very long time, and they make phenomenal products for each person that wants to own one of their products. Next slide, please. So their competitors. The competitors of NVIDIA are Intel and AMD. They are also giants in the space and have multiple products. Intel's current EPS is 6.02. Their PE ratio is 7.24, and their PEG ratio is 1.15. And AMD's EPS is 2.57. Their PE ratio is 37.01, and their PEG ratio is 1.05. Intel used to be the leader in the space and was highly spoken of in the space. But unfortunately, over the past couple of years, Intel's quality control, product performance, and execution on products has fell short to competitors like AMD and NVIDIA. And it's not something I would be interested in investing in. On the other hand, AMD is a leading company that has been doing extremely well for itself. They arguably have taken the spot of what Intel used to be with computer chips. Both of these companies are valued similar to NVIDIA's, but as we can see, Intel has the best numbers of the competitors, but I still believe NVIDIA will be a better investment due to its intrinsic value. Plus, the products that NVIDIA puts out is much superior to AMD's and Intel's. Next slide, please. So personally, I would invest in NVIDIA over Intel and AMD because their financials are stronger and have been doing better in ROI over the past couple of years. Intel has been losing customers due to products falling short to NVIDIA and AMD's, and that has caused their price and their investors' conviction to fall. Overall, NVIDIA is the best option for semiconductors, for the semiconductor sector, and for anyone who is interested in buying. In addition, NVIDIA pays a stable dividend to its investors, and it is one of the key reasons that I have invested in NVIDIA. I will pass it over to Rubaiyat, and he will speak about his analysis on Facebook. Next slide, please.
Thank you, Jason. Okay, so the stock that I have chosen for this particular project was Meta Platforms, Inc. Meta Platforms, that name in the market is recently new, and it has been since November of last year. It was formerly known as Facebook, and it is one of the most major social media platforms available for the average consumer today, with approximately around 3 billion users at the end of 2021. Meta is the parent organization of Facebook, WhatsApp, Instagram, Oculus, and other major companies, generating the most revenue from selling AdSense from these listed companies. Next slide, please. So why Meta? So my initial thought when we were first prompted the project, I thought the first stock that came into mind was Meta, because recently Mark Zuckerberg has announced the metaverse and how it will be integrated into like virtual reality and through the social media platforms as well. And is now branching off to now JP Morgan Chase also incorporating with the metaverse, creating their own blockchain lounge called Onyx. Next slide, please. So the initial investment of metaverse in February, the price for the share was $207.71. The number of shares was 688.46, and total estimated amount invested into the stock was 143,000. Since then, today, it has, as long with Jason with NVIDIA, Meta is the other stock that one of the other stocks has lost quite a bit of money. It's at total loss around 6,258.08 cents. Next slide, please. And since Meta's one of its main sources of revenue is still Facebook, I decided to compare it with one of its bigger competitors, Twitter. So the last close, which was on the 14th, on Friday, the price is now $198.62. And the key differences between the two companies here is we can see it from the beta value, the PE ratio, EPS, and the ROE. Going on to Meta first, one similar between the two companies, they both do not disperse any of the dividends annually to the investors. Meta has a relatively higher beta value because of the current market's volatility, and they had a recent price drop in February, which I will later on explain. And the PE ratio at Meta is much lower than what Twitter is. Meta has a PE ratio of 15.03, while Twitter has a 145.43. So Twitter's value is not what it should. It's very overvalued, and you can see the intrinsic value of Twitter as well is very different from what it's at right now. So it closed at 40.72, and the intrinsic value, the bottom says 11.45. And compared to Meta, the intrinsic value is 154.81, while the last close was 198, which is not too far off. And the return on investment, the ROI for Meta was minus 4.4%, but comparatively to Twitter, if we did the same amount of shares, same amount of money invested since the beginning of the project, we would have gained a total of 9.8%. Next slide, please. So now it comes to the idea if it was the right investment. Personally, if one were to do short trading or put options, I don't think it would be the greatest idea, because I generated a forecast sheet in the right-hand side, and the expected forecast is for the next year. By the end of the year, it will still continue to go down. However, this being metaverse, and it's one of the first major companies to integrate virtual reality, and will hopefully years down the line, we augmented reality. I think it has a large potential to go even higher. The reason why the volatility rate or the beta value was 1.8 is because in February, as you can see, that it dropped pretty drastically because of the cost of the investment into the metaverse, because I believe by the end of the last quarter, metaverse have invested around $10 billion into like the actual metaverse portion of their company. So my opinion would be for a long-term hold for at least a decade, maybe, because it's one of the first companies, like I said, one of the first companies to already take one step ahead of other competitors of technology with the VR enhancements. Now I'll pass it off to Alexis, so she'll explain her analysis on her stock.
Thank you, Rubion. Now I'm going to be talking about the stock that I chose to invest in, which is T-Mobile. And the reason why, and the background info for this stock is how T-Mobile is an American wireless network operator that is owned by a German telecommunications company in Deutsche Telekom. It's headquartered in Bellevue, Washington, and Overland Park in Kansas, because this is the US location. They hold about 64.78% of the common stock. And in the US, it is the second largest wireless carrier with 108.7 million subscribers at the end of Q4 2021. And it provides wireless voice and data services in the US under T-Mobile and Metro by T-Mobile brands, which was acquired with the purchase of Metro PCS, which led T-Mobile to go public on the NASDAQ stock exchange in 2013. Next slide, please. Now we're going to be talking about the analysis. And first, we see how the number of shares purchased is 1,148. And the last price was $126.33. And then for the EPS, it's 2.24. And for the PE ratio is 56.40. And we can see in the chart, in the graph, that from March 28th to April 13th, the stock went up continuously. And for the PEG ratio, it's 1.114. And this, because of that, the stock is considered overvalued because PEG ratios higher than 1.0 are not favorable. And for the market cap, it's $158 and $365 billion. And also for the market value, it's around the same, which is $158.37 billion. And for those, both of those, it's at a higher value. And for the total gain, it's 2,043.44. And also in percentage wise, it's 1.43%. And finally, for the CAPM, the cost of equity is 11%, and the WACCC is 8.3%. Next slide, please. Now we're going to talk about the competitive analysis. So I chose the competitor AT&T because usually when we think of mobile communications, we usually like T-Mobile and AT&T are usually one of the top ones that people gravitate towards too, and also they're just popular in general. And so comparing both AT&T and T-Mobile's EPS, you can see that AT&T's EPS is more favorable since it's higher. Therefore, it's more profitable. And then for the PE ratio, AT&T is more favorable again because of how the higher PE ratio, because of the higher PE ratio, the more you are paying for each dollar of earnings. And then for the PEG ratio, both are higher than 1, which is also suggesting that the stock is overvalued. And then for the current prices, for T-Mobile, it's $126.33. And then for AT&T, it's $19.84. But we can see how T-Mobile is at a higher price. And then for the gain, for daily, it's 1.85% for T-Mobile. And then for the gain for AT&T is 0.12%. And then now we see with the free cash flow how T-Mobile is in the negatives, which shows that, showing that how they spent a lot more money than they already had, like that they don't have. And then for AT&T, it's at a higher price, which is 20,520,000. And then for the market cap, we can see how T-Mobile is higher. Next slide, please. Now, for the last slide, at the time I purchased the stock, it was a good investment. But now comparing it to AT&T with T-Mobile, in the long run, I feel like AT&T would be more preferred, because although T-Mobile has a great network and has performed well in the past, the present value doesn't appear to be too expensive. And then the company's quality isn't great enough to justify such a significant premium over AT&T as we see now. With core AT&T trading at a roughly 6 times ahead free cash flow and a forward dividend yield around 5%, it appears to be a far better value than T-Mobile, even if T-Mobile would be the superior pick if both firms were trading at equal valuations. Now I'll be passing it to Tiffany.
Hello again. So because we were the best performing portfolio, I thought it'd be really fun to have an overall analysis of our portfolio. I think the thing that played the biggest role in us not having as many losses as everybody else was our beta. And honestly, I just passed this information on to Romario, and he did these next few slides that you will see. So as you can see, our overall beta is 0.93. So we are not as volatile as the market, which has been great in this current time in the stock market. Our portfolio is moderately aggressive. We're pretty in the middle of it. And then for valuation, it's pretty similar for overvalued and 3 are under. And it is very diverse with consumer defensive, which is SADNA, healthcare, technology, energy, and communication services. And to the next slide. So these are all of our stocks. The best performing stock was mine with an overall 5.23 increase, followed by Pepsi and then Petra Brazil, and lastly T-Mobile. And as for our lowest performing stock, it was really just NVIDIA. So Jason, next time you're uninvited to this. And then the other two are just have a loss below 5%, which I don't think is all that bad in my opinion. But you know, who am I? Next slide. And this is us compared to everybody else. We are that little green rectangle right there. I actually don't think all these people are in our current class, but we still did better than all of them. So it was important to include them as well. We had the lowest losses in our portfolio, the highest market value, and we are the best at randomly picking stocks. And the next slide. So in conclusion, we had a total loss of 3.82%, and we think we mitigated those losses by being diversified and having a really low beta. And we hate to say that we had a loss, but it's better than a lot of people. And last but not least, we think we would exercise options on NVIDIA. I know Jason said he wants to hold, but it's a stock that lost 32% in the last 2 months. So we would exercise options and hopefully make a killing off of that. And the last slide. Thank you for watching.